Hello, everyone, and welcome to Smart Stock Watch. Today is March 3rd, 2026, and we are breaking down the latest financial results from a retail giant in the automotive aftermarket. AutoZone has just released its second quarter report for fiscal 2026, and the numbers are sparking some interesting conversations on the street. Joining me today is John, our senior analyst from Smart Stock Watch. John, thanks for being here.
It's great to be here. AutoZone is always a fascinating company to watch because they are such a consistent performer in the retail space. And this quarter provides a lot of data points on how the consumer is holding up and how the company is managing its global footprint.
EPS performance and analyst forecasts. Let's jump straight into the bottom line. Heading into this report, the consensus among 10 analysts was an EPS forecast of $27.10. AutoZone actually reported a diluted EPS of $27.63. John, that's a beat on expectations, but it is lower than the $28.29 they reported in the same quarter last year. How should investors interpret this?
You're right, it is a beat against the current estimates, which shows the company is managing its operations better than the street anticipated. However, the year-over-year decline in EPS is something to note. It was primarily driven by a slight dip in net income, $468.9 million this quarter versus $487.9 million last year. While they are beating the immediate forecast, the higher costs and specific accounting charges we'll discuss in a moment did put some downward pressure on the final earnings number compared to 2025.
Revenue and same-store sales growth. Moving to the top line, net sales came in at $4.3 billion, which is an 8.1% increase over the second quarter of last year. That seems like a very healthy jump. What's driving that growth?
The growth is quite robust. If we look at same-store sales, which is a key metric for retailers, the total company saw a 3.3% increase on a constant currency basis. Domestically, they were up 3.4%. This is particularly impressive when you consider that the CEO, Phil Daniele, mentioned that winter storms caused significant disruptions during the last week of January and the first week of February. Despite those weather headwinds, both the DIY and commercial segments performed well.
And what about the international side? The report shows a massive 17.1% increase in international same-store sales, though that drops to 2.5% when you adjust for currency.
Exactly. Currency fluctuations played a huge role this quarter. While the 2.5% constant currency growth in Mexico and Brazil was slightly below their own internal expectations, AutoZone still believes they are gaining market share and outpacing the competition in those regions. The sheer scale of their international expansion is becoming a much larger part of the overall revenue story.
Profitability and margin pressures. Profitability took a bit of a hit this quarter. Gross profit as a percentage of sales was 52.5%, which is down 137 basis points from last year. John, what caused this contraction?
The primary culprit here is a non-cash LIFO, or last in first out, charge of 138 basis points. Essentially, because of inflation and how they account for inventory costs, this accounting charge ate into the gross margin. If you strip that out, the underlying margin was actually quite stable. However, we also saw operating expenses as a percentage of sales tick up slightly to 36.1%. The company is calling this deleverage, and it's being driven by intentional investments in their growth initiatives.
So they are spending money to make money in the long run, even if it hurts the current quarter's operating profit.
Precisely. Operating profit decreased by 1.2% to $698.5 million. They are prioritizing long-term market share over short-term margin optimization right now, especially as they build out their commercial programs and international footprint.
Operational expansion and inventory management. Let's talk about their physical footprint. AutoZone opened 64 net new stores this quarter. Where is that growth happening?
It's a global push. They opened 43 new stores in the US, 18 in Mexico, and 3 in Brazil. This brings their total count to 7,774 stores. They are on track to open between 350 and 360 stores for the full fiscal year. This aggressive expansion is a clear signal that they see plenty of white space left in the market. I also noticed a significant jump in inventory, up 13.1% over last year. Is that a concern? Management attributes this to their growth initiatives and inflation. Interestingly, their net inventory, which is inventory minus accounts payable, is actually negative $105,000 per store. This means their suppliers are essentially financing their inventory, which is a classic AutoZone strength. While the total inventory is up, their ability to manage the cash flow associated with that inventory remains a core part of their financial strategy.
Share repurchases and capital allocation. AutoZone is well known for its share buyback program. Did they continue that trend this quarter?
They certainly did. They repurchased 85,000 shares at an average price of $3,666 per share, totaling over $310 million. They still have about $1.4 billion left under their current authorization. This consistent return of capital to shareholders is a hallmark of the AZO investment thesis. Even in a quarter where net income was slightly down, they are using their cash flow to reduce the share count, which helps support the EPS over the long term.
Key takeaways. To wrap things up, AutoZone delivered a solid quarter with strong revenue growth and an EPS beat, despite some accounting-related margin pressure and weather disruptions. John, what's the final word for investors? Thank you, John, and thank you all for watching Smart Stock Watch. What do you think about AutoZone's performance this quarter? Are the international growth and share buybacks enough to keep you bullish? Let us know in the comments below. Don't forget to like, share, and subscribe for more deep dives into the latest earnings reports. We'll see you next time.